Even the best traders are far from being 100% right in their forecasts. For example, a legendary trader known as BNF turned $15,000 into $110 million with an accuracy of only about 55 to 60% winning trades. In other words, he lost money in almost half of his trades and yet achieved colossal success. How is that possible? The secret is that trading is a game of probabilities, not an attempt to predict the future. In this video, we'll look at why the usual approaches of deterministic thinking don't work in the market and how switching to a probabilistic approach can change your trading. Usual linear thinking versus market reality. In everyday life, we are used to relatively linear logic. If you do A, then B will happen. We expect certainty and clarity in the cause and effect relationship. For example, if you study hard, you'll pass the exam. If you work hard, you'll get a promotion. However, the market behaves differently. It's not linear but stochastic, meaning it's full of randomness. The usual desire to calculate everything and predict every price movement runs into the chaotic nature of the market. Here, a perfect-looking analysis can fail simply because anything can happen in the market at any moment. Sudden news, unexpected actions by major players, and so on. This creates serious cognitive dissonance for beginners. They did everything right, in their opinion, but the result turned out to be negative. It feels as if the market is illogical or wrong, when in fact the problem is in our expectations of certainty where there can be none. Such a deterministic approach breeds fear and stress. When we're sure we must be right every time, any failure is perceived painfully. Psychologist Mark Douglas noted that about 95% of errors leading to losses are related specifically to our attitude toward failure, being wrong, missed opportunities, and so on. In other words, most miscalculations happen not because of a lack of knowledge or poor analysis, but because of an emotional reaction to unpredictability. Fear of losing money, fear of admitting a mistake, disappointment from missed profits. If a trader tries to satisfy their ego and be right in every trade, stress inevitably consumes them and undermines results. A classic example. Instead of exiting at a stop loss, a trader holds a losing position, hoping to wait for a reversal. After all, admitting a mistake is hard. In the end, the loss only grows. The reason is the false belief that one can and should constantly guess the market and a lack of understanding of the probabilistic nature of trading. Probabilistic approach to trading. There is a way out. It's necessary to completely rethink the view on trading, to recognize that it's based on probabilities, not on exact predictions. Instead of asking, how can I be right in this trade, a successful trader thinks, do I have a statistical edge and am I maintaining discipline? Adopting probabilistic thinking means understanding several key truths highlighted by Mark Douglas. Anything can happen in the market. No trade is guaranteed. Any outcome is possible at any moment. To make money, you don't necessarily need to know what will happen next. You don't need to try to be a prophet. It's enough to have a strategy with positive expectation and strictly follow it. Profitable and losing trades are distributed randomly. Even with a great strategy, a series of several losing trades in a row is possible. And that doesn't mean the system has stopped working. In the long run, the math will take its course. If you have 60% winning trades, then over a distance of 100 trades, about 60 will turn out to be profitable. But the specific order of their appearance is chaotic. Your edge is just a statistic, not a guarantee. Having a trading edge means the probability of success with your system is slightly higher than failure. But every single trade is still unique and random. There are no strategies that result in a win every time. You must view your edge specifically as a probability, not as a promise. Every trade is independent and unique. Past events do not dictate the future. As Douglas wrote, stop saying, this is the same as it was once before. The market never repeats itself exactly. Every moment is a new flow of orders. Even if you see a familiar pattern, the result of the next trade may differ. By accepting these principles, you start thinking like a statistician or a player with an edge, not a fortune teller. A good analogy is a casino. A casino doesn't know the outcome of each individual round of play. The outcome is largely random, but thanks to well-thought-out rules and a large number of repetitions, the casino always has a statistical edge over time. Because of this, the math works in its favor, and overall, the casino ends up in profit. A trader who thinks in probabilities is like a casino. He is the house, playing with a positive expectation. Instead of trying to guess every hand, he relies on his edge and understands that the distribution of winning and losing trades is random in nature. For example, with a 60% success rate, you might lose 3 or 4 trades in a row and then take profit on the next 5 or 6. And that's normal. You don't know which specific trade will be profitable and which will be a loss. But if you strictly follow the system over a sufficient sample of trades, you will end up in the black. Realizing this, a trader stops obsessing over the result of each individual position and focuses on correctly executing their strategy. Note that none of the above negates analysis or risk management. On the contrary, they have their own role to play. A probabilistic approach teaches you to combine discipline and flexibility. You still conduct analysis, look for setups with a high probability of success, and limit risks, but you don't expect every such setup to necessarily work out. You understand that the opposite can also happen. This provides inner freedom. If the market goes against you, you calmly accept the loss according to the rules and move on, knowing that success doesn't depend on a single trade. This approach drastically reduces the emotional roller coaster, the panic of a stop loss, and the euphoria of every profit fade because you're looking at the overall statistical picture. A new perspective on mistakes and failures. One of the most important consequences of probabilistic thinking is the re-evaluation of failure. In the traditional approach, a mistake is perceived as a failure of personal ability. A trader thinks, the trade went into the red, so I'm a bad trader. This breeds guilt, insecurity, and sometimes a desire to get revenge on the market by taking random positions to win it back. A direct path to even greater losses. In the probabilistic paradigm, however, we understand that an individual loss in itself means very little statistically. Every trade is just one experiment in a large series. A losing trade doesn't make you incompetent, just as a winning one doesn't prove you're a market genius. It's just part of the statistics. Try to change your attitude. Instead of the thought, mistake equals I'm a bad trader, move to the thought, mistake equals valuable statistics for improving the strategy. In other words, treat every mistake as a lesson. Ask yourself, what went wrong? Was my plan violated, or did a random factor simply work against the position? If you followed all the rules, then a loss is just a cost of doing business, the price of playing the game. If the mistake was due to discipline, say you entered without a clear plan and gave into emotions, then that's valuable information about what needs to be adjusted in your behavior. This analytical approach turns defeats from blows to the ego into stepping stones for growth. Great traders keep a trade journal where they record both wins and losses. Over time, statistics accumulate that allow you to improve your strategy. Remember, a loss is not a sentence, but feedback. By working on your mistakes, you only become stronger as a trader. Furthermore, a probabilistic approach significantly reduces psychological pressure. When you agree to any outcome of a trade in advance, you thereby fully accept the risk. And this, as Douglas notes, eliminates paralyzing fear and allows for serious results. You no longer take risk personally, you don't let it hit your self-esteem. A mistake doesn't hurt you, it tells you where to look next. Such a trader is calm and collected. He's not afraid to click the trade button because he knows the outcome isn't certain, but in the long run, he's on the winning side. This is a fundamentally different psychological mindset. Instead of fear comes confidence, instead of stress, focus on the process. Trading in the zone of probabilities, that's exactly what Mark Douglas calls the state of a successful trader, free from fear and emotional extremes. Paradoxically, to gain more control over the result, you must accept the lack of total control over each individual trade. By giving up the illusion of certainty, you begin to act more effectively. It's no wonder Douglas claimed many fail because they keep seeking certainty in a world made of probabilities. Embrace uncertainty and it will stop being your enemy. By switching to probabilistic thinking, you'll notice the fear of making a mistake fading away. Discomfort from losses will decrease, as you no longer see each one as a personal defeat. In its place, a healthy calm and trust in your own system will emerge. Over time, trading turns into a more measured, even routine process. A series of trades where you simply realize your statistical edge, knowing that collectively it will lead to profit. This approach removes a huge emotional burden. Panic and stress vanish because you no longer expect the impossible but focus on what you actually control, following your strategy and risk management. Ultimately, results improve precisely because of the stability of your psychological state. Be inspired by this idea. Every trade isn't a guessing game, but just one step on a long distance. If a step was wrong, it's no big deal. There are many moves ahead, and your task is to finish the distance in the black. Treat trading as a set of probabilities. One trade won't make you rich, and one trade won't ruin you. Only the sequence of many attempts and how you manage risk matters. Adopting such a worldview is liberating. You start trading without fear or extra tension, as if playing a game where you know your odds exactly. And having this confidence and freedom, you can not only improve results, but also enjoy the process more. Remember, the market promises nothing to anyone, but to a disciplined trader with probabilistic thinking, it offers far more opportunities. Your failures aren't a stigma, but data for analysis. Your successes are the result of following the system, not a magical gift of foresight. The sooner you adopt this new view on trading, the faster fear and stress will vanish, replaced by clarity, stability, and inspiration for further growth. Trade wisely, think in terms of probabilities, and over time, you'll feel a true threshold of stability when the market stops scaring you and starts being seen as a field of opportunities. Good luck on your trading journey.